Hey guys, it's Adrian here, the Canadian in a t-shirt, and today I'll be breaking down the best year-end tax saving tips for Canadians. These are the strategies that I use every single year in December to minimize my tax bill, maximize my tax efficiency, and financially prepare for the new year. These are tips that everyday Canadians can take advantage of at the end of the year to save money on their investment and employment income taxes. For people with business income, I'll be making a whole separate video on business tax saving tips. For this video, I'm going to assume that you understand the basics of how Canadian taxes work, what are tax brackets and marginal tax rates, and the different tax sheltered accounts like the TFSA, RRSP, and RESP. I've already made videos on each of these topics, so if you're rusty on any of this, click the pop-up at the top right to check out my Canadian Tax Guide playlist, and then come back to this video. I'll also include a link in the description box below. The first tip is to maximize your TFSA. The TFSA is one of the best tax-sheltered investment vehicles in Canada. Basically, you can hold stocks, bonds, ETFs, REITs, pretty much any investment inside a TFSA, and all of your investment income will be completely tax-free. So any dividends, drips, or capital gains you earn inside the TFSA will not be taxed. This is awesome, but there is a limited amount of money you can put into your TFSA, and this contribution room is based on your age. Make sure you check out my TFSA Explained video to learn how this all works, what kind of investments you should hold in your TFSA, and how much money you can put into your TFSA based on your age. You should maximize your TFSA as soon as possible. That gives your investments even more time to grow tax-free. So if you still have unused TFSA room at the end of the year, try your best to maximize it right away. Even if you are maxed out, remember, on January 1st of the new year, every Canadian will gain an additional $6,000 of TFSA contribution room. And if you made any TFSA withdrawals this year, you also regain that amount that you withdrew. So in December, even if your TFSA is already maxed out, every Canadian will gain new TFSA room in a matter of weeks. So be prepared on January 1st to contribute to your TFSA and max it out again. My suggestion is to stockpile whatever cash you can in December, so as soon as January hits, you can put that money into your TFSA and start investing tax-free. The sooner you make a TFSA contribution, the more time you'll have for tax-free growth. But when I say stockpile cash, do not take money out of your emergency savings fund. I've said this many times, but it's so important. You should never even think about putting money into investments unless you have paid off your credit card debts and you have an emergency savings fund built up. But what if you don't have any cash in December? What if all your money is tied up in investments in a non-registered account, also known as a margin account? In that case, you're paying unnecessary tax on those investments. Why pay taxes on investment income when you have room in your tax-sheltered accounts just waiting for you? So you might want to consider transferring those stocks from your non-registered account into your TFSA. I'll be making a whole video on how to do this transfer and the implications you have to consider. But basically, you can transfer those stocks into your TFSA, but the CRA will treat this as if you sold those stocks as cash and then move the cash amount into your TFSA. If the stocks have gone up in value since you bought them, you will have to pay capital gains tax when you make the transfer, since it's treated like a sale. So it's a bit of a balancing act. In the immediate future, you'll have to pay capital gains tax on these stocks, so your tax bill for this year will go up. But all future income you earn from these stocks will be tax-free in your TFSA until the end of time. Also, when you transfer stocks into your TFSA, the contribution amount is the current market value of the stocks, not how much you originally bought them for. So if it's January 1st and you only have $6,000 of TFSA room, you can only transfer in $6,000 worth of stocks today at this moment. It doesn't matter how much or how little your initial investment was. The main point is that you want to maximize your TFSA as soon as possible. And the easiest way is to save cash in December and move that money into your TFSA as soon as January 1st hits. This cash approach is simple and worry-free, and you don't have to worry about the potential capital gains tax like you would if you were transferring stocks into your TFSA. If you have children, you should treat your RESP the exact same way as your TFSA at the end of the year. I made 2 whole videos on how the RRSP works and how to maximize your free government grant money, so click the pop-up to check those out. The best strategy with the RRSP is to put in $2,500 into each child's RRSP every single year to get that $500 of free government grant money every year. And just like the TFSA, your RRSP investments grow tax-free, so it's best to put in that money as soon as the new year hits. So in December, I suggest to save some cash and prepare to contribute to your child's RRSP right on January 1st. If you have kids, I would prioritize your RRSP contribution over the TFSA. Both the RESP and the TFSA give you tax sheltered growth, but the RESP also gives you free government grant money, so you don't want to miss out on that. But only contribute $2,500 per year per child to max out those grants. So that's what you should do if you have extra cash at the end of the year. Save it up and get ready to put it into your tax sheltered accounts in January. But what if you don't have any cash and you need money? The good news is that if you need to withdraw money out of your TFSA, December is the best time to do it. I urge you to treat your TFSA as a long-term investment vehicle. Ideally, you shouldn't be taking money out of your TFSA until retirement to maximize the tax sheltered benefits. But if you absolutely need to withdraw cash, December is the best time to make a TFSA withdrawal, and January is the worst time. When you withdraw money from your TFSA, you can't put that money back in for the rest of the year. But whatever amount you withdrew, you regain that contribution room as soon as January 1st hits. Simple example, let's say your TFSA was maxed out, and then you withdrew $4,000 to pay for a new roof. For the rest of the year, your TFSA is still maxed out. You can't put a single dollar back into your TFSA. But on January 1st of the new year, you regain that $4,000 withdrawal amount, plus the regular $6,000 of contribution room that everyone gets. So on December 31st, your TFSA is maxed out. You have zero room. But one day later, on January 1st, you now have $10,000 of available TFSA room. So if you need money, December is the best time to withdraw from your TFSA, since you'll only have to wait a few short weeks to regain that contribution room. If instead you wait until January to make this withdrawal, you'll have to wait a whole 12 months before you can put that money back into your TFSA. Another way to get some money if you need it is to sell stocks from your non-registered or margin account. And if you sell these stocks or ETFs at a loss, you can actually reduce your tax bill for the year. This is a strategic move called tax loss harvesting, and it's usually done at the end of the year. There's a lot to talk about, and I'll be making a whole video on this. But the basic idea is that you intentionally sell a stock at a loss in order to offset the capital gains tax that you would be paying from your other investments. This might seem a little counterintuitive. You are intentionally losing money by selling an underperforming stock. Maybe you don't believe in the future of this company, so it's better to cut your losses and cash out. But in doing so, you will save money on taxes from other stocks which have been profitable. This is very important. This only works in a non-registered or margin account. Do not try this in a TFSA, RRSP, or RESP account. There is absolutely no benefit at all in selling a stock at a loss in a tax-sheltered account. You will just lose money, and even worse, you will permanently lose that precious contribution room. So in a non-registered account, you pay taxes on capital gains every time you sell a stock for a higher price than you bought it for. So if the current market price is larger than your adjusted cost base, basically how much you initially paid for the stock, the difference is a capital gain, and you pay taxes on your capital gains for the year. But what if our stock is at a loss? Let's say we bought stocks for $1,000. That's our adjusted cost base. But now, come December, our stocks have fallen to a market value of only $400. If we decide to sell it right now, we will have $400 in cash, but we will have lost $600 from our initial investment. So we have a $600 capital loss, and you don't have to pay any taxes on this because you only pay taxes on profits, not on losses. Plus, if we sold other stocks throughout the year, we could reduce our total capital gains by this $600 capital loss. That reduces our tax bill. We could even reduce our capital gains tax to zero. If our combined capital gains for the year was $600, we could choose to strategically sell our poor stock for a $600 loss to cancel out our capital gains, and so we won't owe any taxes for the year. So if you've made a lot of capital gains in your non-registered account throughout the year, you can expect a significant tax bill. So at the end of the year, you might consider selling an underperforming stock to reduce your tax bill. But make sure you don't wait until December 31st. You want to give yourself at least 3 business days for this trade to settle and for this loss to be posted. But what if you don't have any capital gains to offset this year? You can actually carry this loss backwards and offset your capital gains from the previous 3 years. And so you'll get a check from the government in the form of a tax refund. Or you can carry forward this capital loss indefinitely and offset any future capital gains. Again, I'll be breaking this down in detail in a future video, but I do want to give this important warning that a lot of people might not be aware of. The CRA has a superficial loss rule to prevent you or your spouse from intentionally buying and selling a losing stock just to offset capital gains. You can't sell a stock within 30 days of buying it, and once you sell a stock, you can't buy it back within 30 days. If you break this rule, this will be considered a superficial loss, and this capital loss will be denied. You won't be able to use this loss to lower your tax bill. You've just intentionally lost money with no benefit at all. So selling a stock at a loss only works in a non-registered account, and it has to be a stock you actually intend to invest in. If you buy it and sell it and buy it back within 30 days, you're not investing. You're trying to game the system, and it won't work. Remember at the beginning of the video, I said that if you transfer a stock from your non-registered account into your TFSA, it's treated as if you sold the stock. Unfortunately, that only ever works against you. It never works in your benefit. So if your stock went up in value and you transfer, it's treated as if you sold it at a profit and now you owe capital gains tax. Unfortunately, if your stocks went down in value and you transfer, you don't get to claim this capital loss to reduce your tax bill. The only way to claim a capital loss is to actually sell it for cash. I'll break down these scenarios in a later video, but here's a good rule of thumb for transferring between your non-registered account into a TFSA or RRSP. If this stock is currently down, but you intend to hold on to it, then do a transfer. You don't get to reduce your tax bill, but hopefully the stock will recover and grow tax-free. But if you don't intend to keep the stock, then it's better to sell it as cash and move that cash amount into your TFSA. Now you can buy a better stock in your TFSA and you can claim a capital loss to reduce your capital gains tax for the year. Another strategy to reduce your tax bill is to wait until the new year to sell your stocks. Again, this only makes sense in a non-registered account, where if you sell a stock for a profit, you'll have to pay capital gains tax when you file your taxes. So if it's December and you sell a stock for a profit, you'll have to pay taxes on those capital gains in a few short months in April when your taxes are due. Instead, if you wait a few short weeks and sell the same stock in January, those gains will be taxed for next year. So you only have to pay those taxes the following April. That's a whole year and 4 months away. So if you just wait a few weeks to sell your stock, you'll earn yourself a whole extra year to enjoy that money before you have to pay taxes on it. This is especially useful if you know that your income will be smaller next year. Let's say that next year you intend to take some time off work, maybe go on maternity leave or even retire. You'll be in a smaller tax bracket next year, so you'll pay even less in capital gains tax than you would if you sold your stocks this year in December. One of the best strategies to reduce your tax bill all year round, but especially at the end of the year, is to contribute to your RRSP. The RRSP is a tax-sheltered investing account designed to fund your retirement. So the earlier you contribute to your RRSP, the more time you have for your investments to grow tax-free. But a huge benefit is that whatever money you contribute into an RRSP, you can reduce your taxable income by that amount. That will immediately decrease your tax bill, and you might even get a tax refund from the government. The RRSP is definitely more complicated than the TFSA, and I've already made 2 videos on the RRSP, breaking down the rules for contributions and withdrawals, how the RRSP tax deduction works, and how to invest in your RRSP to maximize the tax-sheltered benefits. So click the pop-up at the top right to check out my RRSP explained videos. If you have RRSP contribution room available, I would definitely recommend to put money into your RRSP as soon as possible to gain those tax-sheltered benefits. And even if you're in a low tax bracket, remember, you don't have to claim those RRSP deductions right away. You can put the money in and let it grow tax-free, but carry forward those RRSP deductions to a future year when you have a higher income. You're in a higher tax bracket, and thus those RRSP deductions will save you even more in taxes than they would if you claim them right away. But if your income is higher than normal this year, let's say you received a large end-of-year bonus, you'll want to reduce your taxable income as much as possible this year. And one of the best ways to do this is to contribute to your RRSP and even claim unused RRSP contributions from previous years to reduce this year's taxable income. Even if you don't have enough cash on hand in December to add to your RRSP, any contribution you make in the first 60 days of next year can be applied against this year's income. So if you want to reduce this year's tax bill, contribute as much as you can to your RRSP before March 1st. You basically get an extra 2 months or 60 days to make RRSP contributions for the year. Finally, this isn't a tax tip, but it is a money-saving tip that Canadians should definitely take advantage of at the end of the year. Make sure you maximize your employer benefits before December 31st. That means remember to use your vacation days. Don't let them go to waste, especially if you can't carry them forward to next year. And please use your employer health benefits to its fullest. You're already paying for this health plan, so use it. Go to the dentist, get new glasses, get a massage, go visit a chiropractor. I know we all get caught up in work throughout the year, but please make an effort to use these benefits before the end of the year. It's good for your well-being, for your physical health, and for your mental health. And as someone who is now self-employed, I'm telling you, you will miss these benefits when they're gone. So don't let them go to waste. So there you have it. Those are my favorite money-saving tips that I use every December to reduce my tax bill for the year and to put me in a good financial position for next year. Try your best to maximize your TFSA and RESP and be prepared for a new contribution room on January 1st. If you have to make a TFSA withdrawal, make sure you do it in December, not in January, to regain the contribution room right away. If you have a lot of capital gains in a non-registered account, you might want to consider selling an underperforming stock at a loss to reduce your tax bill. But be mindful of the superficial loss rule and don't try to game the system. If your stocks have gone up in value, consider waiting until January to sell them to give yourself a whole extra year before taxes are due. Make sure to contribute to your RRSP to reduce your taxable income for this year or for future years if you expect your income to increase. And finally, take full advantage of your employer's health benefits. Thanks for watching, guys, and be sure to like, comment, and subscribe if you found this video helpful. Every thumbs up and comment really does help me build this channel on YouTube. And hit that bell icon to be notified of my new videos every week. And if you'd like to follow me on Instagram or Facebook at Canadian T-shirt, click the link in the box below or click the links on my homepage. So happy holidays, and I'll see you guys on the next episode of the Canadian in a T-shirt. Bye, guys.